Hello and welcome to Quilter Cheviot's Markets Uncut podcast, your weekly insight into the topics and trends that we've been exploring for you here at Quilter Cheviot. Remember, so you don't miss future episodes, to be sure to hit the follow button on whichever streaming platform you're listening on, or by following hashtag QC Weekly Comment on LinkedIn. I'm your host, Fraser Wilkinson, investment manager based out of our Leeds office. And this week, I'm pleased to be joined by Richard Carter, our head of fixed interest research. Good morning, Richard. So straight to the questions. In the UK, we're seeing slightly positive GDP growth, generally low unemployment, inflation lower than recent years, but still above target. And as a result, all eyes are on fixed interest rates and whether we will see interest rates continue to fall from the highs of recent years. With lower interest rates on cash generally making assets more attractive, the burning question, Richard, is, will UK rates continue to fall? And what does the ultimate long-term rate look like?
Yeah, you're right. Actually, Fraser, cash rates of five plus. I have to say, at the moment, look quite attractive because bond yields have been coming down in the last few weeks. But I don't think those 5% cash rates are going to be there forever. Not at all. Actually, I think Bank of England will be cutting interest rates again by year end. It might go a little bit slower than the Fed's going to go because wage growth, for example, in the UK is still pretty strong. We've had obviously some public sector pay increases as well, but I do think obviously rates will be coming down. I mean, it's hard to say where long term looks like because it will depend on where inflation goes and how the economy goes and all the rest of it, not just here but in the US as well. But at the moment, it looks like sort of 3 to 3.5% is the ultimate destination for most central banks. So we've got a little bit of a way to go, but those cash rates are going to be coming down, I think, as the year goes on.
Yeah, a bit of change on the horizon. Well, we've also got a new government, and I guess just like a lot of new governments, they've made a number of big announcements already, and there's more to come. Looking through all the posturing and the politics and the spin, we are all trying to work out whether their measures will grow the economy, grow asset prices, and lower inflation. So, Richard, what are the indications so far? Is this new government going to be a support or a hindrance to our investors?
Well, it's for sure the honeymoon period didn't last long, did it? They're already into the we've made a policy and now we need to find a way of not doing a U-turn on it on the winter fuel allowance. So they're already finding life a bit tough. I mean, I always think big picture, markets and global equities will not be driven by what Labour says or does most of the time, or the UK government for that matter. Although it is important, certainly in the domestic context. But big picture, US economy, what the Fed does, etc., is always going to be key. I mean, I do think, it sounds dreadfully patronising, but their heart's in the right place. They do want to grow the economy and they do want stability, and I think that's a good backdrop for investors. Whether they're going to get to this long hoped for 2.5% GDP target by sort of reforming planning and a few trips to see President Macron, I'm not sure. I think it's going to be quite a lot harder than that, and quite a difficult target to achieve. I mean, but stability is good, particularly with the public finances when we cast our minds back to Liz Truss era. But it looks like this budget is going to be potentially quite painful, and certainly, given they've ruled out, VAT, income tax, and all the rest of it, it could, the burden could fall on things like CGT, inheritance tax, pensions as well. So for investors, domestic investors, that's potentially a bit concerning. But I would say, there's a huge amount of smoke and mirrors in these budgets in terms of where the debt's going to be in 5 years' time based off some OBR forecast that's very sensitive to a few changing assumptions in terms of where rates are going, where growth's going, what the Bank of England's doing with its gilt portfolio. So I don't think we can read too much into it, but it certainly looks like taxes are going to be going up at that budget.
Yes, I guess there's two things that are certain in life, aren't there?
Yeah.
So, as you say, abroad, the most important economy for investors is the USA. and a substantial portion of our client portfolios is invested in the USA. And US interest rate policies do tend to be a strong influencer of our interest rates as well. So how is the US economic data looking? They haven't cut interest rates yet. And we have seen stock markets pull back as a result. So, Richard, I guess investors would like to know, will the USA cut rates soon? And did they make a mistake by not cutting rates earlier?
They're going to cut rates very soon. In fact, next week probably. So that's going to be welcome news, and probably they're going to cut them a few times between now and the end of the year. So definitely, rate cuts are coming in the States. The Fed has, some people would argue, been a bit slow, but I don't really buy that. We've just spent the last 2 years trying to deal with inflation, and the US economy, to be honest, there's some weakening in the jobs market, but overall it's not doing too badly. You can't blame them for wanting to just see another couple of months of inflation coming down before they make a move. Clearly, some on the committee probably would have moved earlier, but I think on balance, they're probably in the right place. They may cut. In fact, they may cut by 50 basis points at the next meeting, which would be quite interesting. But no, I think they've probably done the right thing, and certainly now rates will be on the way down, and they'll be hoping that they can prevent a sort of serious weakening in the US economy by acting now.
Absolutely. And it's no surprise to anyone, but we've got a US election coming up in November. A new president will be installed in January. And unusually for this point in the cycle, we know very little about the intended Democrat policies. There's usually multiple debates, but postal voting has already started. It does seem a little similar to our current UK government's policy of saying little during the election and then giving us the tough news after they're voted in. So we potentially only have the only presidential debate on Tuesday night. And if you are sad like me and are going to listen to it, it's at 1 a.m. On Wednesday for UK listeners. So, Richard, what pro-investor policies should we be looking for from the two candidates? Will there really be a big difference between the two for markets?
It's certainly a strange election in some ways, isn't it? We think we know a lot about Trump, but we obviously had... he was going to race against Biden, and now it's Kamala Harris, and we don't think we know that much about her in terms of what policies potentially might be. And you're right; the strategy seems to be say as little as possible, get elected, and then deal with it afterwards. I think unlike the UK, there is potentially quite a big difference between the two sides. We know, I think Kamala Harris probably is going to be sort of more of Joe Biden's kind of side of things, investor friendly because the stability and predictability, rather than necessarily because they're doing a load of new policies or tax cuts or anything that are really helpful. But I think it's just a steady hand on the tiller really in the White House is probably a good thing, and markets have done all right off the back of it, haven't they? I think Trump is more overtly going to come out with investor-friendly policies like tax cuts and deregulation. But then on the other hand, you've got the whole instability worries about and unpredictability worries about what's going to happen. What would he do for tariffs, with the Chinese and all the rest of it? And we mustn't forget, the US has got a big debt problem, big deficit. Spending showing no signs of getting under control. I think UK has had its Liz Truss warning. The US doesn't seem to have had, and maybe it never will. But I think bond markets are worried about what Trump potentially could mean for that deficit. And so whilst probably equity investors might quietly prefer Trump and some of his policies, bond markets very much, I think, would prefer Kamala Harris because although they show no signs of being realistic about the debt either, they don't seem like they're going to make it massively worse like Trump will.
No, absolutely. It seems a bit of a distant memory, but around a month ago, we did see a substantial wobble in the global markets, and particularly the Japanese market one Monday morning. There was talk of this being worries about a partial reverse of the Japanese carry trade, where investors have borrowed for near zero interest rates in Japan and used that money to buy and therefore artificially inflate certain global assets. So, Richard, is there any chance of the carry trade wobble, if you want to call it that, coming back? What are the signs coming out of Japan so far?
I mean, I think we have to say that the carry trade wobble in August was, was partly affected by summer liquidity, sort of a bad payroll number that was sort of hurricane affected, and then at the same time, Japanese raising interest rates. So there were a few things that came together. I don't think it will be as bad. If it happens again, I don't think it would be as bad or as sudden or as shocking. And we must remember the yen has actually appreciated quite a bit from where it was at the end of July. So that's probably good. I mean, things are sort of similar in a way that the US economy could be slowing a bit, and there's worries about the labour market. And at the same time, interest rates in Japan are going up, but they are going to be going up pretty gradual. The data there it's okay. It's pretty mixed, I'd have to say, but it still suggests that they could put rates up another few times if they wanted to, whilst the Federal Reserve will be cutting them. So the conditions are sort of still there, but I think you're more likely to see a gradual unwind, hopefully, rather than something so sudden that we saw last time. And fortunately, that we recovered very quickly from that last time it did happen.
Well, I would certainly appreciate that. Well, that's all for today. So thank you, Richard, for those great insights, and to all of you for listening. Did you enjoy our discussion on the podcast today? We'd love to hear from our listeners, so please review the show now, wherever you're listening, and share it on your socials, and tag us at Quiltachieveit. To make sure you don't miss a future episode, just tap the subscribe button, and we will be back next week. In the meantime, head over to our website, www.quiltachieveit.com, where you can read the accompanying market overview, as well as subscribe to our weekly comment newsletter. You can stay up to date with our thoughts on market news, industry insights, and our upcoming events and webinars on our website or our social media pages. And finally, do you have any questions that you'd like to ask one of our experts for our next podcast? Simply ask them via the weekly comments page on our website. We would love to hear your questions. And that's it